Start here in about 3 seconds. It'll count down. Okay. I can cut this part. Hello, everyone, and welcome back to Voice Like a Lion podcast. I'm your host, Stephen Pemberton, and today I have the great honor and privilege to introduce you to some and to reintroduce you to others to one of my dear friends who I met earlier on this year. And he released, in my opinion, one of the greatest books, not only on investing, but on the mental structure of the brain to help you overcome the objections and the obstacles in your life. So I would love to introduce John Jennings to the show.
Stephen, hi. Thanks for having me. I'm super excited to be on your podcast.
And I'm so excited to have you.
For the kind words.
Yeah, absolutely. And we'll get further into it in just a minute. But tell us a little bit more about you.
Yeah, sure. So I'll tell you what I do for a living first. So I'm the president and chief strategist of St. Louis Trust and Family Office. We are what's known as a multi-family office. So we only work with 63 families for whom we oversee around $15 billion of wealth. So it's 200 and something million a family. So we mainly work in the 50 million and up space. So kind of rarefied air. I've had the privilege of working with the top 0.1%, which has been fun. And we have 60 employees. So that's been really cool. I also teach at Washington University in their graduate business school. I have a blog called The Interesting Fact of the Day. I've written this book. I'm a vegan, have 2 daughters, live in St. Louis. So there I am.
Wow. That's incredible. We could go so many different directions with this, but we'll stay in the lane with, before we get into the book, you said something that was very interesting. And we were talking beforehand about investors and criteria and things of that nature. So I heard you mention it a second ago about each family being worth about what, 200 million, 200, 250
on average. There's a pretty big range.
Okay.
50 to 500 basically.
Yeah. So what is the typical criteria for someone to work with you? Is it just that they have to have that much net worth? Is there more to it? What does it look like?
Yeah. So we have criteria that, it's not just about being really rich. That used to be our criteria. Like if you're really rich, we want to work with you. But we found that that's not always a great fit. So we have 6 criteria that aren't just totally about how much money you have. And they form the acronym of SMART-A. So S is significant assets, and it doesn't have to be investment assets. And M is multi-generational. We like to work with, if possible, more than one generation. A is advice that they need, accept, and want advice. And really, you'd go, well, of course they're going to need one to accept advice. They're hiring you. And really what this is we found that there are some people that we call masters of the universe. And really what they're looking for is an order taker, So again, they don't always have to follow our advice, but in general, they're looking for help, somebody that's going to partner with them. The R in SMART-A is range of services. So we do 3 things. We're a family office with trust powers. We can act as trustee and we do investments. So we prefer for them to use 2 or 3 of them. T, to make the acronym work, but it's true, is totally complex. So, we love it when we have a bunch of households, bunch of family members, all sorts of trusts and partnerships and, houses and things. So the more complex, the better. That's where we really shine. And then E is for engage. So, we don't want people that just want us to do everything and make all the decisions. We want people that are going to answer their emails and, prep for meetings. Having a few $100 million is sort of like running a small business, and we need their help. So that's really our criteria for what we look for clients. And not everybody that has a lot of money is a great fit. And we've learned that the hard way over our 21 years of existence.
I love the acronym, because most of the time, and that's why I asked for the criteria, is for those people that are listening, that maybe they fall into that criteria. There's exactly what you need to do before they even reach out. So that kind of reduces the friction for people contacting you. Secondly, is for the majority of people who may not be there, looking at that goal and realizing that that's not just for the ultra wealthy. Because when you look at that acronym, those are things that you should be doing right now. If you're a small business owner, if you're a startup, being able to just in layman's terms, be teachable, right? Yeah. Being able to be engaged and teachable. There was a gentleman I spoke to a few days ago, and he talked about, he works with companies that are about to go under. And this company has 50 employees. They have 100,000 square foot facility all this stuff, and they are about to go under because they're not actively engaged.
Mhm.
They don't actually care about the employees. And I'd actually would like to refute what I just said, because I think that they care. They just don't know how to care,
Yeah.
because it's a multi-generational business. So it's the father that started it, and he's got his sons and daughters in it, and he's the bottleneck. So for
Mhm.
him, is it grown, it's scaled, but he nitpicks them. He does not actually delegate. He doesn't let them be empowered to do their own stuff. So they rebel. And so since they rebel, every single other employee gets affected. So I think that goes back to your point where you were talking about you could be ultra wealthy and still not be the right person. Because this person, in most people's eyes, could be actually highly wealthy, but not the right fit.
Yeah, and we kind of have this rule, like, I'll just go, I mean, excuse my language, but we call it the no asshole rule.
Yeah.
So there's people, we'll put together a list of families we might want to work with. And there's some families where we're like, we'll work with their estate, meaning that after, we'll work with their descendants after they've passed. And, that's really kind of sad, because, wealth can bring opportunities. But, sometimes there's people that have a lot of wealth that just really aren't pleasant or good people. Like, I don't want to be too judgmental. I don't want to say they're not, good people, but they're just not pleasant to work with. So.
And I think that, and I would love for you to correct me if I'm wrong, I think that most people innately, whatever is a good quality or a bad quality, goes back to something that's happened in your life. Whether there was constructive criticism that happened in a certain area that helped you be better, or destructive criticism, which actually pushed you to cope with being a butthole, for basically what you were saying.
Yeah.
Because so many times there's like our true self, who we really are, but then we just put on all these different layers of opinions and decisions that we've made, that a lot of times you'll see that with people, when really, if you get past their external shell, that there's somebody that they're trying to protect, which is usually a younger version of themselves.
Yeah. I think that might be right.
I think that that's fascinating. That actually is a pretty good segue into what I really want to talk about, which is your book, The Uncertainty Solution: How to Invest with Confidence in the Face of the Unknown. And for those of you listening and you're thinking, well, I'm not an investor, invest in yourself and read the book, because I would love to, even just going into the first couple chapters, why did you decide to write the book the way that you did? Instead of just practical tips on how to invest, why did you decide to dive deeper into the human psyche?
Yeah, so I've been an investor or an advisor for 20 plus years, and have helped families of great wealth invest. And as I detail in my book, early on, I thought to be a good investment advisor, wealth manager, like, I had to know everything. I was drinking from the fire hose of information. I spent hours a day consuming everything that was going on in the financial media. And the financial crisis in 08, 09 just really rocked me. Like, I didn't know what to do. I just kept consuming more and more information. And I didn't see a way out. I didn't see what was going to happen. And I would be meeting with clients, and I could feel that they could feel my lack of confidence, because I had a lack of confidence. And I had this coworker that, very smart, one of the co-founders of our firm with me, but she only kept lightly abreast of what was going on. Like, she read as much, as many like novels as, as she did, in People magazine, as much as she did financial stuff. And she was so calm. Like, I was in meetings with her, and she was just like, gave such good advice. And I realized I needed to do something different. And so I went on this quest, this 13 plus year quest, to figure out what great investors do. And I didn't want to be in a situation where I didn't know what to do and how to help my clients. And I found this concept of mental models, which is really what my book is about. Which, mental models are just models you keep in your head of how the world actually works. And you can fall back on them in times of uncertainty or stress, whether it's the investment realm or in what I like to call the real world. So actually, there's 35 mental models, and most of them are applicable outside investing. And so I wrote the book to help people have less anxiety and to feel better in the face of uncertainty, and to know which mental models to pull out when. And it's really been great, because it's really our firm's investment philosophy now. And when we hit times of great uncertainty, whether it was during COVID, when the stock market dropped nearly 35%, the fastest it's ever dropped. It was just breathtaking. I think we all remember it. Or even what's
Mm-hmm.
going on right now with the debt ceiling fight. So I just published an article in Forbes 6 or 7 days ago about what to do about the debt ceiling. And really it's mental models that help tell you what to do. Because if someone asks me, what's going to happen with the debt ceiling? Will it be raised in time? My answer is probably, but maybe not. What happens, what's going to happen if we get really close? And what's going to happen if we don't raise the debt ceiling? And I'm like, I don't know, but it's going to be bad. Right. But yet that doesn't keep us from having just really sound advice for our clients in the face of this, which is this entire concept of knowing which mental models to use to pull out.
And this is why I wanted to have you on, because you're sitting there, president, helping people with 15 billion is a gigantic number. And the fact that you're able to do that, but be so level. And what I mean by that is you don't seem unapproachable. There's some people that I've spoken to who they have a minuscule amount of wealth comparatively to the amount that you manage. And they want to make everything ridiculously complex. And that's actually what I love about the book is there's stories in there. One very particular one that I remember where you were talking to somebody else who was a president of a large trust, that the way that they managed their clients' money was they made the portfolio very diverse and complex because they basically wanted to impress the client.
Yeah.
And I really love that you make it simple with the mental models. One that I come back to quite often, which I didn't realize I did all the time, was patterns. Mm-hmm. The story talking about getting shocked and flipping over the rocks, and why we build these patterns is to basically keep us safe. But what does that do in a negative sense? And being able to see that and be able to work through that. And that's what I love about the book. For people who want to invest in the future, for people who even right now just want to invest in their mental health, because we hear that all the time. We hear mental health. I'm walking through this mental health journey, or I've got this mental health disease. Yeah. I think if we look at these mental models and apply them to our lives, and I can talk from experience because through the past few months since we talked, it's been an absolute roller coaster of emotions because of building a business. There's things that go well. There's things that don't. There's clients who pay. There's clients that don't pay. Then all of a sudden you're in this pinch when you're building a new business where it's like, I have bills to pay. I've got things to do. It's not going the way I expected. But this book right here has helped me stay grounded through all of it. It's helped me. I haven't invested with you. I haven't invested in the stock market, but I've been able to invest in myself with these tips and tricks. So I would love to, for those listening, describe what is the one mental model that you go to for you, or the top 3 that you go to for you when you get in an uncertain situation?
Yeah. So it depends on whether it's, investing or, otherwise, but I'll hit the top investment one that I think is in the book. So like, if you're a listener and you're like, I'm interested in investing, it sounds like kind of an investment book. I don't really want to buy it. I don't really want to read it, which is totally fine. What one mental model should I take from this as an investor? And it's the one that I call the stock market is not the economy. And so here's how it works. So economic growth, which is measured by GDP growth, and what the stock market returns in a year have absolute zero correlation. From World War II to the end of 2021, it was 0.03. So basically zero. So what this means is that there are calendar years where the economy is just humming along and is doing great, and the stock market doesn't do well, or maybe even it's negative. There's years where the economy is positive and the stock market's negative. And then there's the vice versa, which is the economy is contracting for an entire calendar year and the stock market's positive. So in fact, since 1930, there's been 19 calendar years where the economy was contracting. And in 12 of those 19 years, the stock market was positive. And most of the time, more than 18%. And you might go, well, that's bonkers. How can we be in a recession? The economy is shrinking. Jobs are being lost. Like everything is bad. How is the stock market up? And the answer is that the stock market predicts what the economy is going to do in the future-ish. Like it's not perfect. Mm-hmm. But the economy does not predict what the stock market's going to do. Now, as an investor, you'd love to have be able to look at what's going on in the economy and go, I should adjust my stock portfolio accordingly. But unfortunately, it's the flip. So what this means, let me give you an example. So in 2020, we just mentioned COVID. So the stock market drops from, the peak was February 26th. The trough was March 23rd of 2020 with COVID. So it dropped nearly 35%. So what was happening on March 23rd? Things were bad, but they weren't nearly as bad as they're going to get. So Stephen, if we were sitting here on March 23rd and I said, hey, I have a crystal ball, guess what's going to happen? We've just had our 1,000th COVID death. But by the end of the year, there's going to be nearly 350,000 in the US. Over the next 3 years, there's going to be 6 million deaths worldwide. We're not going to be able to travel internationally. Entire industries are going to be shook, and we're going to have a 9% GDP decline this quarter, like the worst since the Great Depression. We're going to have 14.7% unemployment. Unemployment claims are going to spike. Everything is going to be horrible. And everybody's saying it's going to go on for a few months. This is going to go on for years. It is just horrible. Like, if I told you that, or you told me that, if you're the one with the crystal ball, I think we'd all be like, okay, I'm going to take all my money out of the stock market. I'm going to bury it in my backyard. But the bottom was March 23rd. And between March 23rd and December 31st, the stock market gained 70%.
Wow.
You're just like, pow, bonkers. Like, how does that happen? What happens all the time? So again, the stock market predicted the recovery and bottomed. Why did it bottom on March 23rd? Don't know. Same thing happened in 08, 09. The bottom was March 9th, 2009. Things were still really bad and getting worse. I remember March 9th, 2009. It was one of these days where I was like, oh my gosh, pulling my hair out. How much lower is it going to go? The news was bad and getting worse, yet the stock market bottomed. And this happens over and over and over again. And it happens on the upside too. Things seem like they're going fantastic. And then the stock market drops. And so as an investor, you might go, well, Jennings, it's my last name, that is horrible news. Like, I don't want to read this book. But what I want is I want certainty. I want to know what's going to happen in the stock market, or I'm not going to invest. But actually, the way you use this mental model, it's freeing. It means invest with a long-term perspective and know that even like you don't have to know everything that's going on. And even if you knew the future, it wouldn't help you. Therefore, just invest in a diversified manner. Have enough cash if the stock market drops. I mean, if it's money you need to live off of, don't have it in the stock market. So have enough cash, be able to live. So like, Stephen, as you're building your business, like it probably makes sense that you're not like, oh, I'm going to be, not investing in my business and putting in the stock market. Horrible idea, right? Mm-hmm. But as your business, starts just throwing off just crazy cash, and you're like, what do I do with all these Benjamins? Like all these $100 bills. Then you go, okay, now invest in the stock market, and you don't need to know what's going to happen in order to invest well. So I'd say that's probably the most important investment mental model.
I love that. I love that for so many reasons, because even outside of investing, there's so many times where it's like, I want to predict exactly, you see it all the time. And with business, it's like, I can guarantee you $100,000 in 6 months if you work with me for a small upfront fee. But how can you guarantee that? And what I mean by that is, if somebody is telling you, I guarantee that you're going to be successful no matter what, as long as you join with me, I would happen to guess that they have experience, and you got to read the fine print. It's if you show up every Monday at 6 o'clock, if you're there at 6:01, that immediately voids the guarantee and all these different things, because you can't guarantee anyone's going to be successful because there's so many different variables. It's the same thing with, I love one of the things you talk about in the book, which I look at and I love to challenge people with, is correlation versus causation.
Oh, yeah.
Because correlation versus causation is, I could sit there and come up with, well, you said that March 9th, 2008, and you said March 23rd, 2020. So that lets me know that the economy is not good and it's hitting March, that it's actually, that's the worst it'll ever be is in March. And so then I know for sure that that's when it's going to be bad. So I can just start investing and know that it's going to immediately make money. Right. But that's correlation, not causation.
There's a pattern there. You're absolutely right. There's a pattern there. It just is a meaningless pattern. Because then I could say, well, Stephen, remember the .com bubble? The top of the stock market bubble was March 24th, 2000. So there was its top. These others were the bottom, But yeah, we like to see patterns, and we're gonna look for explanations and patterns, even where they don't exist.
Mm-hmm.
And the main definition of uncertainty is where we can't see a pattern. Because when we can't see a pattern, it makes us feel anxious. Because back in the day, being able to see patterns gave us a survival advantage. Being able to see patterns of prey or weather, or are those berries poisonous or nutritious? So those sort of things. And so we are the descendants of those people that survived because they were great pattern recognizers. And so the situation is now that, most of us live in abundance, and we aren't faced with the sort of situation that our ancestors were, where one mistake and maybe you would die, right? So, like, for instance, like I have a friend that, riding his bike broke his pelvis like bad in like multiple places. Like 10,000 years ago, he'd probably be dead.
Mm-hmm.
So it's like, like there's all these things that used to kill us that now really aren't threats, but yet we see threats everywhere when we can't detect a pattern. So we're looking constantly for patterns. And there's something, if you look at coincidences, and I'll tell you a crazy coincidence. So on Friday morning, I went to breakfast with somebody that I'd met like 10 or 15 years prior, and he reached out to me, and we connected, and we went to breakfast. And we're in St. Louis, Missouri, having breakfast together, and it's going great. Like, we scheduled it for an hour. We're like an hour 45 into the breakfast, and his name is Richard. He's like, I gotta go. I'm on a podcast in like 45 minutes. And I go, oh, really? Which one? And he's like, oh, it's with this guy, Brian Adams. I'm like, huh. I'm on a podcast today with a Brian Adams. And I'm like, does he live in Nashville? He's like, he does. Like, oh my gosh. Like, look at that coincidence. That is like crazy. It's like, pow. Like, how does that happen? But there's something I talk about in my book called Littlewood's Law of Miracles. And the way this mathematician defined a miracle in like day-to-day parlance, like, things that are just crazy coincidences, are things that are a 1 in a million occurrence.
Mm-hmm.
And he said, okay, if you're awake 16 hours a day, you can see or notice things on the rate of about 1 a second. I think that's a little high, but bear with me. So that's 30,000 experiences a day. And if there's 30 days in a month, it's like 900,000. So basically, you're going to experience these just crazy, improbable things once a month. And even if you go, okay, I'm not noticing, things or experiencing things once a second, maybe it's 15,000 a day or whatever. But the point is highly improbable things are going to happen over and over and over again. And every time, it's human nature to be surprised, like completely shocked. And I can't explain how it was that I had breakfast with a dude in St. Louis that was going to be on the same podcast that I was from some guy in Nashville. But it happens. And the point is it happens all the time. And the way you relate it to investing in life is just realize that the highly improbable or the unexpected is going to happen over and over and over and over again. And to set up both your investment portfolio and your life to take that into account. Because as humans, we're linear thinkers, and we're just going to take the present and the recent past, and we're just going to extrapolate it. But the chances are the future is going to be hugely different. So like if you go back, like I graduated from college in 1992, like there was no internet. There was no GPS on cars. Like, and there were Swiffers. There was no Swiffers. You actually had to just use a broom and a mop. It was like crazy, right? And like all these things didn't exist. And like in 1992, as I'm graduating from college, like there's no way I could have predicted what's going on now. And like every 5-year period that happens, but yet we only, project out. So as we sit here today in May of 2023, like 5 years from now, things are going to be so much more different than we expect. And so the idea that we can predict this, or we're going to take big bets on things, thinking that we know how things are going to work out, probably isn't the way to go. Like the role of randomness and chance and luck and wild, different experiences is really important.
And that's one of my favorite concepts that you go through in the book, besides correlation and causation, because that one's fun whenever somebody just says it's irrefutable proof that this is happening. It's like the one that you talk about is the women CEOs, and how I remember that one very vividly, because, or the ones where you sit there and you look at the law of basically sample size.
Yeah.
And I love going through the book because you get these different mental models and what they look like. And especially when you look at 1 in a million, I think it is so important to look at your life in that same sense where you could have what is labeled a miracle happen to you in a good way, but you
Yeah.
could also have something go completely sideways that you never expected.
Right.
So being ready to, in your case, being able to have your portfolio in a place to weather that, but also having your mindset in a place to weather that. And I'm sure you've gone through this with clients where
Life.
that
Yeah.
1 in a million will hit and they're just like, okay, I'm pulling everything out. All right,
Yeah.
let's start reevaluating this portfolio. It's not working. Like, this is what the economy is doing. The second bank just went down, or the third bank just went down. I'm pulling all my money out of the bank. It's like, if your mental state is not ready to weather those 1 in a millions, then you're gonna end up giving up on things. When if you just would have persevered, then you would have reaped the benefits.
Yeah, absolutely. That's spot on. And can I tell a story of the women CEO?
Yeah.
Okay. So I was at this investment conference years ago, and I was drinking this, kind of horrible conference wine, which is like kind of what they serve at these investment conferences. And I'm talking to this woman who's the CEO of an investment firm. And so I was asking her, what does your firm do? What's your investment philosophy? And she said, oh, it's simple. And they've been in business about 4 years. She said, we only invest in companies that have strong female leadership. So companies that have female CEOs or presidents or strong presence on the board of directors. And we do that because studies have shown that female-led firms outperform. I was like, oh my gosh, that is amazing. So when I got back to my office after the conference, I spent days digging into this, and I found a lot of support for it. So I detailed the studies in my book, but there's all sorts of studies showing that female-led firms over the past 3 and 5 and 10 years had outperformed, like, handily, all the rest of the companies. So I brought this to our investment committee. I was like, maybe we should look at this, right? And then a few days later, I met with a client who's one of the smartest people I know. He ran a Fortune 100 company. And I told him about this. And I said, our investment committee is looking at it. And he said, that's really interesting, but are you sure that, female leadership styles is the cause of the outperformance? Or was the company performing well for some other reason and they happened to hire female CEOs? Maybe having female leadership is a symptom of higher performing firms and not a cause. And I will tell you, like, if it was almost anybody else, I would have dug in and go, no, I researched this. Like, there's studies showing this. There's definitely a causal link. But because he's so erudite, I was like, okay, I need to dig into this. So I did something that's very hard, because we all have this bias called confirmation bias. When we believe something, we go out and we look at things that support what we already believe. And that's what I had done when I looked to find these studies. I just Googling things like, do female-led firms outperform? And I was getting all this stuff saying, yes, they do, right? But anyway, by digging in and asking the opposite question, disprove it, I found that there were studies going the other direction, that just like my client questioned, that suggest that possibly that companies that are already outperforming then can focus on things other than just making money. And they can say, now we want to, do things in line with our values. We think it's great to have, female leadership. Or even more cynical, this one psychologist said, there's companies that do things like say, we're going to be really good for the environment. We're going to recycle our annual reports. I was like, that's not a big deal. Or companies that buy carbon credits just so they can seem like they're green. Like, oh, we're just going to pollute and then we'll just buy credits. It's like, okay, we're just signaling that we care. We don't really care, right? So he was suggesting that it's really a symptom of already high performing firm. And it's interesting, over the next few years, indices of female-led firms then underperformed. I was like, oh, interesting. So let me just say, the jury's out on whether there is a causal link between female leadership and outperformance. There needs to be more studies in statistics. There's something called longitudinal studies. Those haven't been done, that are needed to do to tease out a causal link. But the point is, and the point of the story is whenever we try to jump to conclusions and say A causes B, one of the things to ask is, do they have a common cause, or is B a symptom of A? Or I mean, excuse me, is A symptom of B, not a cause of B? You know, what is the order? So yeah, I have this chapter that I go into things like that, you know, with stories. And I'll tell you, like I get concerned when I talk about this book because I have like chapters on correlation and causation, and you know, stock market's not the economy. I have one called the trivial many versus the vital few that talks about bell curves versus power law distributions and how important it is to know which applies or not. And I can imagine like you're listening and going, oh my gosh, like I don't want to read about power law distributions versus bell curves. And really the challenge in this book and what was so hard was how do I make this like stories and kind of funny and light instead of just like lecturing at people. So that's really what I tried to do in the book, because, you know, some of the you know, some of the concepts are, you know, a bit heady.
And that's what I love. There's another great book that I've read part of. And the reason why I've read part of is because most of it was lecturing you on these concepts. And at the time, A, the book is 700 pages. And B, is it's every single chapter is another concept. And it's not necessarily given to you in stories. It's given to you in research studies, but it's not given to you in a way that is digestible. That's what I love about your book is, yes, you have all these principles and concepts and bell curves and all these fancy graphs and lines, and you can so easily get lost in it if it wasn't for your storytelling.
Yeah. Well,
and the storytelling makes it chewable. It makes it digestible. So with that, I'm holding up the book for those of you who can't see. Go get the book, The Uncertainty Solution. If somebody's interested in the book, where can they get it?
Yeah, so it's Amazon, Barnes & Noble, all that. I also have a website, johnmjennings.com. So JOHNM Jennings.com. And importantly, I write this blog called The Interesting Fact of the Day. I publish it about twice a week. So if you go to johnmjennings.com, there's in the menu a tab that says the iPod for Interesting Fact of the Day, and love to have a subscriber or anybody subscribe. So I just write on things that are not investment related, just all sorts of random sort of things. So some of my most clicked on posts are what happens to a bullet shot straight up in the air? Why do females have neater handwriting than males? How many people in the US are 7 feet tall or taller? You know, all sorts of things. I've been writing some about AI and, you know, things like that. So just all sorts of just different, hopefully interesting things. So I've been doing that since Groundhog's Day 2017.
Wow. So a long time. Yeah, it feels like a long time. It's I think something that's very interesting that has come out of your book, because I was landing the plane, now I'm about to take it back off, I guess, for a second, is what's very interesting.
You want.
Yeah, but what's very interesting is I've sit there and I look at time. I look at things as they're relative. So for me, being almost 30, 6 years is a long time. But if you are 100, 6 years is not a long time.
I did a blog post on that. Why does time seem to speed up as we age? So that's one of my blog. Yeah, that's one of my blog posts I did years ago.
That's incredible. That's hilarious. And I think that's where if so many things that are in this book are so applicable to life, that's why I want people to get it. And I keep harping on it, because even that, just things are relative.
Yeah.
When things look bad to me, it's like, man, this is the worst thing I've ever walked through. It's like, but is it the worst thing you could walk through, or is it just relative? Right. And what I mean by that is, if you are in a beautiful home and maybe your business isn't doing as well as you expected it to, is that the worst thing ever? Or is there people that have it worse? Is it relative? To some people, you're in, because especially in America, we are much more privileged than other countries. Other countries would love to have our problems.
Amen.
And that's, yeah, exactly. And so it's all relative. And that's hard to see. Absolutely. In your moment of desperation, of sadness, of difficulty, it's hard to see that it's relative. But if you can get that perspective, almost a third party perspective on your situation, instead of just being in the situation, then you'll realize that, oh, wait, this is just relative.
Well, and even with all these families that have all this money, I mean, they're just people. They have the good and bad days, and they have stresses and worries. And, you know, you'd think that, oh, you know, if you have a few $100 million, everything's, you know, puppies and butterflies. And there's actually a lot of burden and issues that wealth creates. And I'll tell you, overall, I think it's kind of better to have wealth than not. There's all sorts of advantages to it, but it definitely has a flip side of the coin that isn't all positive.
Yeah, I agree. I've seen that. I've talked to so many people who you would expect they have the house, they have the car, they have the wealth, but yet they still deal with the same problems. And realistically, there's a businessman who's a billionaire, he's a restaurateur, and
Mhm.
he talked about this. So when COVID hit, all restaurants and casinos that he owned had to shut down.
Mhm.
So he's doing it's like $1 million a month in overhead that he's just having to cover. And you would say, but he's a billionaire. That's not that bad. It's like that's bad. I mean, imagine if you're making $100,000 a year and you've got to pay $1,000 a month just to cover overheads, like
Yeah.
12,000 a year just to try to keep it up.
Yeah.
Where really, realistically, it'd be more like 1,500 to 2,000 a month. That you're just trying to keep something up, that nothing is happening. You're still paying employees. You're still having to figure out what do we pivot, what do we do. It's the same problems, just much more magnified. Wealth magnifies. It
Yeah.
doesn't. Like wealth magnifies what you're walking in. It magnifies those problems that seem really big when you're small, but then as you get bigger, you realize, oh, that's a pebble, and now I'm facing boulders, and you're having to work around these boulders and figure it out. But yeah, that's all relative. And to for people who want to follow you besides your website, I would highly suggest that if this has landed with you at all, go and look at his blog, follow his blog, get the book. I'm going to say that probably twice more before the end of this. But where else can people follow you?
Yeah, so there, or my personal website, or you can go to my company, my company website, or Amazon, or what have you. So all over the place.
Awesome. John, thank you so much for being with me today. Thank you so much for being an amazing guest and for writing an amazing book. And I
Thanks.
hope you have a great rest of your day.
Cool. Thanks, Steven.